Welcome back to book club. Glad you're back with me. We are going to jump into, we're gonna jump into chapter 8. This is actually the start of chapter 8. Disclaimer, there is a smoke detector which is beeping even though the battery is brand new. Forgive me, excuse the noise, but that is gonna be going off in the background. I don't know, I haven't figured out what's going on with that yet. Okay, anyway, so we're gonna jump into chapter 8, Redrawing the Price Bar, Japanese Candlesticks. So in this chapter, we're gonna go over introducing candlesticks, going over a few specific patterns, and using candlesticks with other market tools. All right, let's jump in. So candlestick charting displays the price bar in a graphically different way from the standard bars described in chapter 6 and 7. Yeah, candlestick charting was developed in Japan at least 250 years ago in the 18th century, where traders applied it to prices in the rice market. A trader named Steve Nyssen, I think that's the correct pronunciation, brought candlesticks to the attention of Western traders in 1990. Candlestick patterns became instantly popular because they embody the principle of imputing trader sentiment to the bars, as in shaven top, where the close is at the high. As I say in chapter 6, the close at the high means strong bullish sentiment. Today, every software program offers to display bars in the conventional way or in candlestick format. Trading guides abound on how to use candlesticks. Steve Bigelow has several books on candlestick trading and software add-ons, including profitable candlestick trading and high profit candlestick patterns. In this chapter, I break down the components of a candlestick and explain why candlesticks are so useful. Note that in some instances, a standalone candlestick is a pattern in its own right, and such candlesticks always have a name. That's a bird. That is a bird. Okay. Okay, where are we at? Okay, so I break down the components of a candlestick and explain why candlesticks are so useful. Note that in some instances, a standalone candlestick is a pattern in its own right, and such candlesticks always have a name. For more on patterns, check out chapter 9, named Candlesticks and Small Series of Candlestick Pattern Numbers in the dozens, and I can't cover all of them in this chapter. So here I select a few that stand out. Appreciating the candlestick advantage. Candlesticks are visually compelling. You can quickly and easily figure out how to identify a handful of the top candlestick patterns. The following are some of the advantages you can get from candlesticks. So number 1, many candlesticks are simple to use and interpret, many of them a splendid place for a beginner to start figuring out bar analysis, as well as for old hands to achieve new insights. Your eye adapts almost immediately to the information in the bar notation. Number 2, candlesticks and candlestick patterns have delightfully descriptive and memorable names, charming and sometimes alarming, that contain the seeds of interpretation. The names help you remember what the pattern means. Among the colorful names are abandoned baby, dark cloud cover, and spinning top. Fascinating. Number 3, candlestick bar patterns and their interpretation are widely known, so you can expect other participants in the market to respond in a specific way to specific patterns. Number 4, you can use candlesticks on any chart with any other indicators, just like sound bars. Number 5, candlestick shapes can be dramatic, so they can often bring your attention to a trend change earlier than standard bars do. As I described in chapter 7, some exceptional bar patterns embody a forecast that's usually correct, such as the breakaway gap and the island reversal. Standard bar analysis offers very few such patterns, but candlestick analysis offers dozens. And lastly, candlestick patterns excel in identifying strategic market turning points, reversals from an uptrend to a downtrend or a downtrend to an uptrend. So dissecting the anatomy of a candlestick. Candlestick notation emphasizes the open and the close. Figure 8-1 shows the open and the close mark at the top and bottom of the box, named the real body. A thin vertical line at the top and bottom of the real body, named the shadow, shows the high and the low. So see chapter 6 for discussion of the basic bar components, open, close, high, and low. I present some more details on the candlestick bar components in the following sections. Drawing the real body. The real body encompasses the range between the open and the close. The color of the real body tells you how the daily struggle between the bulls and the bears played out. Note that in candlesticks, the real body emphasizes the open-close range, whereas the traditional bar charting, you look at the high-low range as discussed in chapter 7. The colors mean the following. White real body. This is, again, you're gonna have to kind of decipher what the translation would be with the actual exchange that you use, or whatever, you know, specifics you've set up for like the color coding on your chart, okay? So when they refer to the white real body, just listen. The close is higher than the open. A real body is bullish, and the longer the body, the more bullish it is. A long candlestick indicates that the close was far above the open, implying aggressive buying. In the daily battle of the bulls and bears, the bulls won. Okay, so when they say white body, they're talking about a bullish candlestick. And then when they refer to the black body, they're referring to a bearish candlestick. Okay, so black real body, the close is lower than the open. A black real body is bearish, and the longer the body, the more bearish it is. A long black candlestick indicates a preponderance of sellers throughout the session. In the daily battle of bulls and bears, the bears won. The two candlestick bars in figure 8-1 show the identical open and close, but coloring one of them black creates the optical illusion that it's bigger. The black bar, so for most people, I think most people, their bars that are bullish are gonna be green, and their bars that are bearish are typically gonna be red. Again, some people apply some funky color patterns to their charts, but typically that's what you might expect. All right, so the two candlestick bars in figure 8-1 show the identical open and close, but coloring one of them black creates the optical illusion that it's bigger. The black bar demands your attention, which is one reason candlestick charting is appealing and effective. For more appealing aspects, see the section Appreciating the Candlestick Advantage earlier in this chapter. Okay. As in all bar analysis, context is crucial. Although you may sometimes use a single candlestick bar as an indicator in its own right, most of the time you use it in relationship to the bars that precede it. One small white body bar and a sea of black bars, for example, may mean the bulls won that day, but it was a minor event. The one white bar may signal that the bears are losing power, but you wouldn't use it at all. You wouldn't use it all by itself to call the end of a black bar downtrend. Doing without a real body, the doji. A candlestick that has no real body or only a few small A candlestick that has no real body or only a very small one is named a doji. So a doji looks like a cross, literally like a stick figure cross. And a doji, the open and the close are at the same or nearly the same level. Figure 8-2 for 3 types of dojis. On its own, a doji doesn't tell you much about market sentiment, except that the traders are indecisive and sentiment is in a transitional phase. It's a neutral bar, neither bullish nor bearish, that gains meaning from its placement compared to the preceding bars. So let's look at that. Okay, when you see a doji after a prolonged uptrend, the doji may mean that the buyers are coming to the end of their bullish enthusiasm. A doji immediately after a very long white bar in an uptrend shows that the market is tired. This particular doji is named a bearish doji star. A bullish doji star is a minor or a mirror image. It comes after a big black bar in a downtrend. In most cases, it signals an impending reversal. Tip: the doji form contains important information. Regardless of the shadows, although shadows have their own additional meaning and are covered in a later section, always take notice of a doji or series of dojis after a trend has been in place for a while. It's a transitional bar and you should always be on the lookout for any transition that can affect your trade. Okay, catching the shadow. I want to make sure we're not going too far. Okay, catching the shadow. The high and the low prices are shown in the shadows, which you can think of as a wick on the top or a tail on the bottom. Although the shadow is secondary to the real body in importance, shadows can contribute useful information about market psychology too, and modify your interpretation of the body. Shadows offer special interpretive clues in 3 instances. The real body is a doji. The shadow is missing. The shadow is extremely long. Shadows in the doji bar. In many instances, the doji is just a plain one with ordinary same-size shadows as shown in figure 8-2. That's the figure that you just saw. So number 1, doji dragonfly. Okay, so that was the middle one that looks like a T. Look for the long lower shadow. That means the open, high, and close were the same or nearly the same. Sellers were trying to push the price down and succeeded in making a low, but they didn't succeed in getting it to close there because the close was back up at or near the open. Buyers must have emerged before the end of trading and bought enough to move the close to or near the high. So how you interpret the dragonfly depends on what bar patterns precede it. Your options include the following. If the price move is a downtrend, the dragonfly may mean that buyers are emerging and the downtrend may be coming to an end. If the dragonfly appears after a series of uptrending bars, buyers failed to push the price over the open to a new high while sellers succeeded in getting a low. So the uptrend may be in trouble. Okay, so now moving on to the gravestone doji. Take a look at the long upper shadow in figure 8-2. So that is the 3rd one to the right. Yeah. This bar, the exact opposite of the dragonfly, is formed when the open, low, and close are the same or nearly the same, but a high creates a long upper shadow. Although buyers succeeded in pushing the price to a high over the open, by the end of the day, the bears were fighting back and pushed the price back down to close near the open and the low. This push is failed effort at a rally, but you can interpret the bar best in context of the other bars that precede it. If the gravestone bar appears after a series of uptrending bars, buyers failed to get the close at the high. Sellers dominated and the uptrend is at risk of ending. If the price move is a downtrend, the gravestone doji may mean that buyers are emerging and the downtrend may be ending. Missing shadows. The absence of a shadow at one end is called a shaven top or a shaven bottom. To get a shaven top or bottom, the open or close must be exactly at the high or the low, as you can see in figure 8-3. These candlestick bar notations are called, wow, I don't know how to pronounce this, Marubozu candles. That may be incorrect pronunciation. And you can classify, I've never heard of that before, and you can classify the types of candles by using the following descriptions. All right, so number 1, shaven top, no upper shadow exists, and when the open or close is at the high, okay, let's run that back. No upper shadow exists when the open or close is at the high, okay? A shaven top can be black or white and come about in 2 ways. If the open is at the high, the day's trading was all downhill. Not only is it a black candlestick, bearish to begin with, but it's also doubly bearish that no net new buying occurred after the open. If the close is at the high, the net of the day's trading was at higher prices, which is bullish. The candlestick is also by definition white or a bullish sign. Okay, a shaven bottom, no lower shadow exists when the open or the close is at the low of the day. A shaven bottom can come in 2 ways. If the open is at the low, bulls dominated all the day's trading. If the close is at the low, all of the day's trading points to a bearish sentiment. All right, so let's look at the shaven top and the shaven bottom. Really long shadows. Okay, so when the shadow is as long as the real body or longer, traders are expressing a sentiment extreme. They may not follow through the next day by pushing the close to the high or low breaking point though. Evaluating a long shadow is therefore tricky. Okay, so wait, let's look at this real quick. Okay, so as a general rule, judge a long shadow by its placement on the chart relative to preceding bars, such as the following. Number 1, long upper shadow. The high of the day came well above both the open and the close, whether the real body is black or white. Here's how you can interpret a really long upper shadow. If the price series is, is in an uptrend, the long upper shadow is a failure to close near the high. If the uptrend is nearing a resistance level, the long upper shadow may signal a weakening of the uptrend. So the long upper shadow may signal a weakening of the uptrend. If a long upper shadow follows a doji bar indicating indecisiveness, you should worry that the uptrend may be over. If the price series is on a downward or on a downtrend, the long upper shadow suggests that some market participants are buying at higher levels, especially if a long upper shadow follows a doji bar. You should wonder if the downtrend might be ending, okay? And then long lower shadow. A long lower shadow means that the low of the day came well under both the open and the close. Whether the real body is black or white, here's what that probably means. If the price series is trending down, the long lower shadow is a failure to close near the low. If the downtrend is nearing a support level, the long lower shadow may signal a weakening or an end of the downtrend. If the price series is trending up, the long lower shadow suggests that traders weren't willing to keep buying at the high levels right up to the close. They were exiting under the high and therefore think that new highs aren't warranted. The signal can be a warning sign of the trend The signal can be a warning sign of the trend decelerating or ending. Okay, cool. So we're gonna stop right there. And when we come back, we'll do sizing up emotions, identifying special emotional extreme candlestick patterns, turning to reversal patterns, and more. Okay, cool. Good read. Thank you for joining. See you next time.